Hi, welcome. It's John Gillingham from Gillingham CPA. Today, we're going to be doing the Small Business Tax Planning Seminar, where we're going to be looking at key things for particularly the new small business owner who's just starting out, needs to focus on. Now, at Gillingham CPA, we actually have quite a few young businesses, as I'm young in business as well, now going on my 8th year doing this professionally as a CPA. Very many years. So please, GillinghamCPA.com, email me, john@GillinghamCPA with any questions. Know that this presentation is really for generalities. It's generally geared towards a single filer. There is a tax table based on 2014 rates with the most basic scenario. So please, this is not tax advice. Consult me as an engagement or with someone else to really look at your tax situation personally. And if you're the do-it-yourselfer, I completely understand. That's kind of how I got into this. I honestly started at UCSD doing my own tax return, helped out a few friends. It was so freaking complicated that I decided to just do it professionally. So if you're a do-it-yourselfer, I still think there's a lot of tremendous tips you can pick up. Obviously, if you can't afford advice, do your research, and let's just get right into it. So today, a few things we're going to go over is IRS compliance, reducing your taxable income vis-a-vis deductions, making estimated tax payments as required, entity status, tracking expenses, tax advantages, and avoiding an audit. We are also going to be touching over health insurance and saving for retirement. And before we get started, I would just like to say if we could please hold the questions for later, and I really appreciate you coming, but we'll get this one online to help some of the small business owners. This presentation is focused around business owners in California. There aren't massive differences there for other states on the federal level, but if I throw out some California-specific stuff, that's because most of my client base is in San Francisco. And again, educational only, not tax advice. Okay? Thanks so much. Here it goes. You are a small business. Now what? What are you going to do? I mean, you're your own boss, you're your accountant, and you're the janitor. You're taking out the trash. There is so much to do. Let's drill into these right now. You're responsible now for your vacation, your tax withholding, including Social Security taxes. So when you have a W-2 at a normal, regular old job, the employer, the person who is employing you, is automatically taking out tax from your check. If you make very little, they're still taking out the Social Security tax and the Medicare tax. All in all, figure 12% or so, and there's two ends to that. Now, when you're self-employed, the number one thing that hits people, especially starting out self-employed, is that they don't pay in estimated taxes for their self-employment earnings. And it's possible that you have $30,000 of income and you're still hit with a tax bill. And you're probably not used to paying tax, and that's because your employer has been automatically withholding stuff from you and then paying the other half, as well as probably taking care of some other things like healthcare, which we're going to touch on as well. Healthcare now is more complicated than ever. Thanks to our lovely administration, healthcare is now available through different exchanges. Now, the IRS has gotten involved and to incentivize people to make sure they have health insurance. You are now required, unless you make some kind of exception. Now, if you do not have an exception made, meaning maybe some sort of religious reason or very few exceptions, honestly, then you are going to be paying a penalty tax because you did not sign up. Now, here's the other thing that really threw me off here, and this being for 2014 specifically, but this will probably continue on. What really, really threw me off is that in order to take advantage of some of these credits that you might have access to, now tax credits are dollar for dollar, you get those back. They can be as good as cash. If they're refundable, they are as good as cash. If they're just regular tax credits, if you owe tax, you get that amount back. So it's super valuable. Now, The government's requiring you to go through an exchange. Now, how did that work in my world is I was getting covered, let's call it for $300 a month, direct with another carrier. However, I strategically, just in case, went through an exchange and got precisely the same plan, a little bit better for the same amount, just in case I might have a possibility for these government incentive credits. Now, most of the people who are going to get those credits are going to be low income. Now, the government is also subsidizing healthcare for lower income people. Now, what happens if your income increases all of a sudden? So you might apply for healthcare, get a subsidy, so maybe you're paying $100 a month. Subsidy just meaning that the government is pitching in some money for you. And then you win the lottery. Well, guess what? That subsidy, that amount that they're pitching in for you, is going to now be owed. You're going to repay that. So just be aware. All in all, you are going to be faced with a lot of different things as a small business. And I highly recommend that you seek professional help so you can focus on your business and growing your business. Your time is money, and it's going to be all over the place trying to do everything from empty out the waste paper basket to get health insurance to establish some kind of retirement account like an individual retirement account, an IRA. Do you really want to become your own tax expert? I don't know. Now, if you happen to be married or a registered domestic partner, do you want to be the one in the family who's signing on those tax returns? Not sure, but just do your homework otherwise. Record keeping and audits. I always recommend small business owners keep your bank statements separate. Small business owners are typically all over the place. They're hustlers, they're doers, they're movers, they're shakers. I love you guys, but you gotta keep records. You need to have bank statements. Keep them. You don't have to be the physical kind, but pull down the PDF. If you have a secure sync to the internet, go ahead and sync that stuff up. Also, to keep our physical receipts and digital receipts. It's not that hard. As a sole proprietor, when you're spending money out of your pocket, it might be business, it might be personal. Just keep all the receipts. If you get into an audit situation, the IRS is extraordinarily reliant on receipts and bank records, and they'll trace through every transaction. So if you're on the fence of whether it's business or not, go ahead and save that receipt just in case you need it. And audits, I'll tell you, they happen sometimes 2 years after the fact, after you've moved, after your dog ate your tax receipts, after your computer took a dive. Now, in water that is, these days we have the drive, the cloud. Find a secure solution for you and utilize it. Now, when you pay yourself as a sole proprietorship, which is what this is mostly geared for, as a sole proprietorship, you are the business. You have no partners. You actually cannot have partners. You're operating by yourself. So as a sole individual proprietor, you need to keep in mind, how are you compensating yourself? Now, you can accumulate and make money in your personal account, but commingling is a bad idea because at the end of the year, if you didn't do any of your accounting, imagine that, someone can sort it out for you much, much easier if the one account was designated for bank statements. So I'd recommend 2 accounts. And when you're ready to pay yourself, things for the rent, the groceries, items that are never a business expense for you, assuming this is 100% personal rent, it is going to be best for you to move maybe once a week, maybe once a month, one sum of money from your business account into your individual account. What does this do for you? This makes a clean transfer, like $1,000 called the draw, or $5,000. In this way, the accountant who's ever doing your books, or when you're doing your books, know that if it's a $1,000 amount or $2,400 reoccurring, it's going to be obvious that that's compensation to you. Now, whether or not you take that money and transfer it, you will be taxed on the profit, which is basically all your income minus your deductions. You're going to be taxed on that profit anyway. So withdraw money as you see fit, but do it in whole amounts. Make it easier on yourself. Also, I very often get the question, what solution do I recommend for bookkeeping? My honest solution and what I recommend my friends, clients, and family is to keep it simple. have a system that works for you. I love QuickBooks. I do even costing on specific projects. I use QuickBooks Online myself. Now I know there's a lot of other solutions like Xero, FreshBooks, or just plain old Excel. But a lot of businesses starting out, they don't have a lot of revenue and they don't have a ton of transaction volume. So spending an inordinate amount of money on a software solution that you may or may not get right, or you may or may not want to dedicate the time to, is questionable. Now, if you do want a nice software solution, say a QuickBooks Online, start at the first of the year so those transactions start dumping in. That's the great advantage of QuickBooks Online or these other software solutions like Xero. They automatically pull from your bank and dump into the software. Does that mean it's automatic? Absolutely not. It just means you don't have to be typing all the time. And these software solutions are also very smart. They know if they see a particular expense all the time, such as Staples, and last time you categorize that as business supplies, then it will know that Staples next time will automatically be categorized, and then it's up to you to just accept that. So in that way, software can be really good, but I actually have a 2-page organizer, as well as a multiple-page organizer, as well as an Excel template available at gillinghamcpa.com/downloads. Audits are very scary. They often happen 2 years after the fact. They can request all your bank statements, including others. I've seen as many as 26 months of bank statements requested. Now for the real small business owner, highly unlikely. However, it's possible. Go ahead and have all your records. I think I've stressed that enough, including paper receipts. Why keep current records? I actually just had a lovely experience where I saw an automatic billing notification come through my email account telling me of a renewal of a yahoo.com premium email address, which I had purchased several years ago. Apparently that has been reoccurring every single year and somehow slipped by. My cable company was overcharged me $200. I also didn't realize how much I was spending on software. These little things add up a ton. And I also realized that I wasn't gaining enough business in one particular type of area. All by keeping current accounting, you know minute by minute up to date. This is oh so valuable when you start making decent profits because you must know and have an idea, at least an estimate of your income so that you can prepare proper estimated taxes. Why be a year behind when you can be current?